Good afternoon, everyone. Thank you so much for joining us for our Power Hour hosted by KPMG on government and lending programs and tax considerations today. Drew from our team will be moderating the Q&A session a little later. For those of you who don't know me, I'm Becky Shaw, Membership Support and Engagement Coordinator here at the Oakville Chamber. Some of you may have attended our virtual Power Hour sessions last month in April. You'll notice that our format is a bit different this time. We've decided to host this one as a webinar due to the interest from our members on this topic. Okay, so just a couple housekeeping items before I pass this over to our wonderful host. We have enabled the Q&A function. You'll see that at the bottom of your screen there. So please feel free, ask questions as you have them during the presentation or after. This is where Drew will come in. And we'll do our best to get to all of them. If we do run out of time and we're unable to get all the questions live during the webinar, Aaron and Sebastian have graciously agreed to answer those questions that we couldn't get to, and I'll send them out over email. So since not everyone can have their microphone and camera on today, the chat box is set up for you to be able to speak to your fellow chamber members, introduce yourselves, and let everyone know who you are, where you work, and so on. So without further ado, I will pass this over to our hosts from KPMG, Aaron Gillespie and Sebastian Rusin. Thank you so much for joining us today.
Thank you, Becky. Happy to be here and go over this stuff. This stuff has been extremely relevant these days. I know people are, some people are struggling, some people are doing okay through this time, and hopefully we can help answer some questions. So I am going to control the slides here. Becky, you've already covered it. We'll go into government assistance and lending programs. I'm going to cover that, and then Sebastian's going to go over certain tax considerations that business owners may wish to take into account during these times. So I'll start with the government and lending programs, and we're going to try to cover, Sebastian and myself cover material in about 30 minutes total, and then we'll do our best to leave probably about 25 minutes at the end for Q&A, and I think that'll probably be the most valuable part. So with that, I'll kick it off. So there have been a number of federal government subsidies and credit programs announced over the past several weeks. And we've certainly heard them, heard the Prime Minister come out almost on a daily basis and quite often have a new program that he's announcing. This is going to be a high-level overview of some of those programs and what they look like at this time. However, it's important to note that the programs are changing, and people should continue to monitor the status of these programs as well as new announcements or potential extensions to some of these existing programs. So the first one I'll mention briefly is scientific research and experimental development claims. The reason why we're mentioning this isn't something new, but I wanted to mention it because the CRA is looking to expedite and approve refundable SR and E&D claims. And that's basically for your Canadian controlled private corporations. So in general, smaller companies, and this isn't larger public type companies or very large private companies, but for the smaller Canadian controlled private corporations, they are looking to expedite the approval of claims to refund amounts back to taxpayers faster. So if you do get refundable SR&ED credits, you're encouraged to file your return as soon as possible to get those refunds. The next one I'll mention is the Supplemental Unemployment Benefit Plan, or the SUB-P as it's known as. And this again is not a new program, but it's becoming very relevant right now. What this plan does is it allows an employer to top up employees while they're laid off and receiving EI or CERB benefits. I'll talk about the CERB in just a moment. But what it's doing, you can think of this plan as similar to like a traditional maternity or paternity top-up type plan. And so what it does is if the employee is laid off, they're on EI or the CERB, the employer is able to pay them an additional top-up amount of their earnings, up to 95% of their normal weekly earnings. And the big advantage of the sub-P plan is that obviously it helps with employee retention from an employer perspective, but from an employee perspective, these top-up earnings from the employer don't count as remuneration for EI purposes. So it won't lead to, in general, it wouldn't lead to, say, a clawback of their EI or CERB benefits. So that's the big advantage of the plan. With the, again, these are not insurable earnings for the purposes of EI or the CERB. The next program that I wanted to cover is the work sharing program. We've seen, again, not a new program, but there's been some changes to it during this time, and certainly there seems to be a lot of uptake on the program. So the work sharing program is a program that allows employees to agree to a reduced schedule of work and share the available work with other employees over a specified period of time. The program can run for up to 76 weeks, which is about double what the program normally would have ran for under legislation in the past, but under a temporary measure during these times, the program can run up to 76 weeks. So the advantage of the program is that employers are able to pay for the work that's available, and employees perform the work and are paid for the work they're performing, but the EI system actually tops up the employee's pay. And so what this does is it avoids layoffs, keeps people working, even when there's a time when the business is slower. Last thing I'll mention about the program is that you administer it based on what's called work units. So generally what you do is find groups of employees who are willing to participate and perform similar types of functions. So you don't have to do it company-wide, you do it on the basis of a work unit in the company. The CERB, I've referenced this, or I referenced it earlier when I talked about the sub-P plan. So the CERB is the temporary measure that was brought in really to provide relief to the EI system. And it offers employees a benefit for up to 16 weeks if they've lost their income due to the pandemic. And it's a broader program than EI in that it covers self-employed individuals or people who otherwise wouldn't have been eligible for EI. They may be eligible under the CERB. And generally this is open to individuals who have earned $5,000 of income in 2019 or within the previous 12 months prior to their application. The CERB program is also going to capture all EI applications made after March 14th. And the reason being, again, is this is a program that's being rolled out much quicker, less requirements, less, I'll call it red tape ahead of time. And it's eliminated, or it's trying to provide relief to the EI system. Certainly hasn't eliminated that, but trying to provide relief to the EI system. There are two wage subsidy programs that I'd like to talk about. This is what's garnering the most attention right now, it suggests, as it relates to these government programs. So the first is the temporary wage subsidy, and it provides employers with a 10% wage subsidy for wages paid during the period of March 18th to June 19th. And there's a maximum of $1,375 per employee and a maximum of $25,000 per employer. The program is limited, as it relates to for-profit businesses, it's limited to relatively smaller businesses, but it likely would apply to a number of the people on the line, I'm certain of that. The second wage subsidy that's garnering a lot more attention is the Canada Emergency Wage Subsidy. And this is also being referred to as the 75% wage subsidy. So this program is open to an expanded number of employers, including larger corporations. The subsidy is available to eligible employers that see a drop of at least 15% in their gross revenues for the month of March and 30% drop in gross revenues in the following 2 months, April and May. The decline in revenue may occur using a year-over-year comparison, such as March 2020 compared to March 2019, or the employer may compare the results in March, April, and May to an average of January and February from 2020. The amount of the subsidy is generally equal to 75% of wages paid to employees, to a maximum of $847 per week. There is no overall maximum for the subsidy for the employer. The program applies to wages paid from March 15th to June 6th. And the program is designed to motivate employers to bring back workers from EI or from the CERB, help them keep employees employed, And the application process is broken into 3 different claim periods, and that first claim period is now, it has been met. That was April 11th was when it ended, and the application process opened up last week on Monday. It's important, however, to note that although you can apply, as I said, the program opened last week, you can apply for that first period now and the second period shortly. You do have up until September 30th to make your applications, and that's important to note. If employers have sufficient cash flow, it may be beneficial for them to wait because it helps them to get organized. We're not aware at this point in time of ways to amend their claims, for example. So it may be worthwhile to hold off, wait, ensure that your application is correct and accurate, because there are potential penalties that can apply. Again, I'm not aware of at this point in time a way to amend your claim, and there's special elections that may need to be filed and things of that nature. So you may benefit from waiting and making sure that your ducks are in a row. With that, I'm going to flip to the next slide and just talk a bit about tax filings and tax payments. So there's been some change in terms of deadlines and due dates of things. So I won't cover them all because it's quite extensive, but certain types of taxes may be deferred in order to conserve cash. So for example, income tax installments and income taxes that became payable after March 18th, they may be deferred until September 1st. GST, HST remittances that became owing on or after March 27th, they may be deferred until June 30th. There's changes to customs and duties payments, for example, for the months of March, April, and May. They're extended until June 30th. And during these extension periods, there's no interest or penalties payable on these deferred payments. There are a number of other taxes that are able to be deferred and due dates as it relates to actual tax filings. I will point out that source deductions, there's no change to the due date on remitting payroll source deductions. But as it relates to a particular type of tax, whether it be EHT, for example, I encourage you to check on the particular type of tax because the deferral is particular to the type of tax, and it's different for each type of tax. I'll mention the Canada Emergency Student Benefit. This was announced on April 22nd, and we are waiting for some further details on the program. But in general, the program is designed for post-secondary students and recent graduates who are unable to find employment or unable to work due to something due to the pandemic, something related to the pandemic. And this will run from the months of May through August. And it provides a benefit to those individuals of up to $1,250 per month. The Canada Emergency Commercial Rent Assistance Program, it was announced recently. Same thing, we're waiting for further details on this. It's going to be administered through the Canada the Canada Mortgage and Housing Corporation, CMHC. And they have released a backgrounder. You can find it on their website. They have released a bit of a backgrounder that generally lays out the program, but we are expecting more details on it. Effectively, what the program will do is provide a 75% rent subsidy for tenants. However, it's going to be administered where the government's going to provide 50% subsidy to the landlords. The landlords are being asked to, or they, as a requirement of the program, they're going to have to reduce tenants' rent by 75% or more. So in that, you can tell that the landlord is actually being asked to take a 25% reduction in their gross rent receipts than they otherwise would receive. The program will run for the months of April, May, and June. And the subsidy is a forgivable loan that is administered through mortgage lenders. To be eligible, the tenant needs to pay less than $50,000 in rent per month and have temporarily ceased operations due to the pandemic or have experienced a 70% drop in their pre-pandemic revenue. It is anticipated that the program will be up and running shortly. I'm not sure if it'll be up by next week. If not next week, the week after is what we're anticipating. We aren't certain in terms of the implications where the property is not mortgaged, where it's debt-free. We're not quite clear as to how the program will work in that case. And I think there'll be a lot of pressure on relationships between tenants and landlords, since again, the landlords are being asked to take a reduction in their rent by at least 25%. And the landlords are making the application, but they need to ensure, to be eligible, they need to ensure that the tenants have met these tests. So it's a little bit awkward that way, in the fact that the landlords are going to have some kind of attestation or some kind of proof from their tenants that they meet the qualifications, in particular around the being out, operations being closed or revenue having been dropped by 70%. On to a couple of credit programs that are out there. So the Canada Emergency Business Account is being implemented by eligible financial institutions in cooperation with the EDC. And it provides interest-free loans of up to $40,000 to small businesses and nonprofits that have annual payroll between $20,000 and $1.5 million for the calendar year 2019. If the loan is repaid on or before December 31st, 2022, this will result in a 25% loan forgiveness, so up to $10,000. And if it's not repaid by that time, the remaining balance on the loan will be converted to a 3-year term loan at a 5% interest rate. Two other loans that I'd like to mention. First is the BDC co-lending program. Under this program, eligible businesses may obtain credit of up to $6.25 million, 80% of which would be provided by the BDC, and the remaining 20% would be provided by the business's current financial institution. Additionally, the EDC guarantee, guarantee allows financial institutions to issue new operating credit and cash flow term loans of up to the same amount, $6.25 million, with 80% guaranteed through the EDC. And these loans are required to be repaid within 1 year. These programs are available to all businesses that were financially viable prior to the outbreak of the pandemic. And between the two, eligible companies could obtain credit of up to $12.5 million through both programs. The last one I'll mention is the BDC working capital loans. They provide working capital loans of up to $2 million, again, through the BDC. And there are flexible terms and payment postponement that can be made for up to 6 months for qualifying businesses. And again, there is a requirement that the business needs to be financially sound prior to the pandemic. There are also 3-year term loans with principal payment deferrals for up to 12 months. So I hope this was a useful summary of some of the subsidies and credit programs that are available to employers at this time. And with that, I'm going to pass it over to Sebastian to outline certain tax planning ideas that may be useful during this time.
Yep. Thanks, Aaron. So I guess it's worth noting here that that these tax considerations are probably good business hygiene sort of at any point in time, but particularly amplified during our current situation. So I'll just sort of run through the 7 here and provide a little bit more detail and context to each. So the first one would be adopt tax-related cash management strategy. So Aaron's run through a few of those, just being mindful of exactly when your installments and your corporate tax liabilities are due. The government has provided sort of a deferral of when exactly you need to pay your installments. So be aware of the installment requirements. So at this point, none are required until September 1st. The other thing that you might want to consider is if your taxable income is expected to be less in 2020 as a result of the current situation. When you are, again, required to make your installments, you might want to consider recalculating them to see if you actually have to make the size of installments that you were anticipating on making, because I mean your installments are based on various formulas, one of which is your anticipated income for the current year. So to the extent that that amount is less than it otherwise would have been, you can back off on the installment. So I think it's been mentioned that that corporate taxes are due are not due before September 1st for any tax liability that arose after March 18th of 2020. Your GST, QST payments that arose after March 27th through to including May 31st are now due on June 30th. The other thing that you might want to consider here is recovery of HST on your bad debt. So to the extent that you have bad debts, and you have identified which ones you're not going to recover, when you're doing your HST, make sure that you claim the HST as the HST that you did pay on those, or that you did remit as an input tax credit to get that HST back. If you're expecting any sort of a refund, whether it's corporate tax or any one of the programs, the SHRED programs, then we would suggest you want to file that as soon as possible in order to get the cash into your bank account. The next point there or here is improve the tax position. So again, I mean, you identify your back debts. Obviously, the bad debt write-off will create lower income, which will in turn reduce your tax liability. You want to look at your inventory to the extent that you have any, and if any of it requires a write-down because of obsolescence or otherwise, you'll consider doing that. Consider write-down of abandoned or obsolete equipment. And another one under this heading would be sort of in-house utilization, in-house loss utilization strategies. So things such as management fees, for example. If you've got a loss co and a profit co, you might want to consider paying a management fee from the profit co to the loss co to the extent that it's reasonable, of course, to create an expense inside the profit company, reduce the tax liability there, and theoretically you should have no tax liability in your loss company because the losses should sop up some of the management fees. You got asset sales from one profit code to from a profit code to a loss code, or vice versa, and we'll get into that and under the heading number 4 there. Amalgamations and wind-ups, which are similar, but to the extent that you have losses in one company and profits in another, you might want to consider winding one up into the other or amalgamating the two of them in order to utilize the losses of one corporation against the profits of the next. And under this heading as well, you got preferred share loan strategies. This one is, in fact, what happens here is it's a play where you get to write off interest in a profit co and create interest income in a loss co. Again, it's to save tax in the profit generating company and create some taxable income in the loss company that otherwise isn't going to pay any tax anyways. So the third one here is review your corporate structure. So you might want to consider asset protection strategies. So at its simplest term, or in its simplest, you would have a holding company where you would pay up your surplus retained earnings into the holding company in order to protect it from any creditors that you might have in your operating company. So for example, if you've got $1 million of retained earnings or any sort of surplus in your operating company, you can send that excess surplus up into a holding company in a tax-free and tax-efficient manner, and protect that excess surplus from potential creditors. Another strategy that we're looking at right now with a number of our clients is a refreeze. So to the extent that you've frozen the assets of a corporation with the intent of sort of passing it on to the next generation, or for whatever reason, if it's beneficial to have a lower valuation of that company, you might want to look at that. You might want to look at that strategy right now, just because, you know, given our situation right now, valuations are certainly not as rich as they otherwise would have been a few months ago. The point number 4 here is the asset sale strategy. So again, this is if you've got a profit company and a loss company, or even if you've just got a profitable company, or assets that you're not otherwise using, you might want to consider selling those in order to generate either some sort of a loss that you might be able to carry back to previous taxation years. There are strategies where you can actually sell the losses to related corporations. So if you've got an asset in a profitable company that you're looking to get rid of, we can certainly transfer that over tax-free to a loss company, trigger the gain in the loss company, and you've otherwise sold your asset, you know, theoretically tax-free if the losses are big enough to sop up any of the gains. There's also sale and leaseback strategies here that we can implement, where again, creating a loss or creating an expense in a profitable company and generating revenue in a company that otherwise has losses, in order to be able to sop up any of that income. Intercorporate financing or intragroup financing. Here we're looking at strategies like capital dividend account payout. So what a capital dividend account is, it's non-taxable portion of capital gains that you've generated in the past. We would suggest here that if you are contemplating financing something through the payment of a capital dividend account, you do so before you trigger any losses, in order to maximize that tax-free portion. Because what otherwise happens is, if you trigger the losses before you pay out the capital dividend account, then the capital dividend or the amount that you can pay out tax-free is actually reduced by the capital loss that you otherwise had. One thing in the intracorporate financing is you want to look at, if you are financing through intercorporate debt, you want to look at reasonability of the rates on that debt, and that holds true as well for the management fees that we touched on in point 2. And CRA doesn't really have a policy on what exactly is reasonable, but I mean, our rule of thumb is you sort of look at what you would pay an arm's length party for whether that's debt or a management fee. So if you're going to pay somebody, an arm's length party, $100,000 to as a management fee, you can't very well pay a related party $200,000. Otherwise, you run the risk of that management fee being unreasonable, and the CRA would deny that fee based on a reasonability test. And the same holds true for the interest. So if commercial rates right now are 5%, you can't create a loan and charge 15-20% rate of interest on it. Otherwise, you also run the risk of CRA saying that amount is unreasonable, and as a result deny you the expense. And it's worth noting that although they deny you the expense, they won't necessarily deny the income inclusion. So in situations like that, you might run into situations where you're actually paying double tax. The next point here is optimize the tax incentives and credits. So I mean, I think Aaron did a great job in summarizing this stuff. So I mean, that speaks to all the new subsidies that are available to us, as well as some of the other ones, such as the shred claims. So you want to make sure that you file those in a timely manner in order to start any refund or any cash inflow as a result of the wage subsidies or any of the other loans that might be available to your business. And then the last thing here is just whenever you're implementing these things, you want to consider the impact that what you're doing has on your employees. So one that kind of comes to mind here is the integration between, for example, the CERB and the CEWS. So to the extent that you have employees on the to the extent that you have employees that are claiming the CERB, you want to know how that integrates with the CEWS, so that by bringing them back to work, you don't throw them offside of what they're collecting under the CERB. Also, things such as, for example, if you're trying to preserve cash and you are providing non-cash benefits to the employees, you want to make employees aware that even though it's a non-cash item, doesn't necessarily mean that it's non-taxable to them. So to the extent that you're providing certain non-cash benefits, you want to make the employees aware that they might owe tax on those non-cash benefits. Yeah, I mean, I think with that, I will turn it over to Drew to take questions from the floor.
Perfect. Well, thank you, Sebastian, and thank you, Aaron, for your presentation here. Encourage everybody who is watching down in that Q&A section. Please do enter your questions, and I'll be able to read them to our two guests today. We also had a number of questions that were submitted in advance. But starting off here, the first question is, as an employer with an incorporated company, if you pay yourself a salary through that company, are the wage subsidies applicable to you?
Okay, I'll take that. Thanks, Drew. Yes, so I will say that the short answer is yes. Both the 10% and the 75% wage subsidies do apply to what I'll call non-arm's length employees. However, like everything, there's caveats to this. So I'll give an example. Under the 75% wage subsidy, there isn't an ability to take your wage post March 15th and increase it in order to increase your subsidy. Or say, for example, if that non-arm's length person didn't have a wage prior to March 15th, so from say Jan 1 to March 15th, they didn't have a wage paid, they couldn't again now pay a wage in the subsidy period in order to get the subsidy. It wouldn't work. So there's a different calculation that's different than have the employee been at arm's length with the company. So there's a different calculation, different formula for non-arm's length employees. Short answer is yes, but like everything, the devil's in the details. So you need to actually work through the legislation to determine what your subsidy would be, because the calculations and the rules are different for what we call non-arm's length employees.
Great. So building off that, Aaron, how does the 10% temporary wage subsidy interact with the 75% wage subsidy? What's the difference in terms of eligibility, and can you claim both during the same period? Okay,
well, that's a good question, and this one definitely has come up a lot. So it is really important to understand that first of all, the 75% wage subsidy is not a replacement for the 10% wage subsidy. There are separate pieces of legislation, separate programs, separate subsidies. Okay, that's the first thing people need to understand. Once you're comfortable with that point, then comes the interaction between the two. And the interaction is this in general. It's that the 10% wage subsidy, or sorry, the 75% wage subsidy will be reduced to the extent that the employer is eligible for the 10% wage subsidy. And it will be reduced dollar for dollar to the extent of the amount that they were eligible, that the employer was eligible for under the 10% wage subsidy, regardless of whether the employer actually claimed the 10% wage subsidy or not. So in making your claim for your 75% wage subsidy, the starting point for the employer is to determine, am I eligible for the 10% wage subsidy? And if the answer is no, great, there's nothing you need to do. But if the answer is yes, you then need to calculate, well, how much am I eligible for under the 10% wage subsidy? You should claim it, because irregardless of whether you claim it or not, that amount that you've calculated reduces your 75% wage subsidy.
Okay, that's great, thank you. Sebastian, I think this one goes to you here. Can you talk a little bit about the implications of if you write off accounts receivable and then collect that at a later time? How does that impact?
Right. So yeah, I mean, what'll happen is obviously you'll get the write-off in the immediate term. Now, you know, it's worth noting here that you don't just want to take you know, all your accounts receivable over 90 or over 120 days and start writing them off. Like, in order for them to be deductible for tax purposes, you actually have to specifically identify which ones are uncollectible, and you know, I'm sure you'll have to provide some sort of support as to why you chose those ones. So what happens when they get collected at a subsequent date is they just get brought back into income. So to the extent that you got a deduction in year one, if you or in 2020 say, and you subsequently collected in 2021, the amount of that receivable that you did collect just goes back into your income and tax that year. And similarly for the HST. So to the extent that you took an ITC for the HST that you thought was non-collectible, when it gets brought into income the following year, you'd remit that HST then.
Okay, great, thank you. Here's another question from an attendee. As a registered charity, we have funding agreements with the United Way and the Region of Halton. These revenues have not changed due to the COVID-19 issue, but the rest of our revenues have significantly decreased. The revenues from the funding agreements constitute approximately about 80% of our overall revenue, with the remaining revenues, membership donations, are 20%. So I think they're saying they don't hit that 30% threshold overall, but that's because of funding in place. So would they qualify for the wage subsidy?
Right. Okay, that is a good question. And I am going to see if I can actually call up the legislation on the fly, because there is for a registered charity, there is an ability when they test their revenues that they are able to exclude certain revenues when they make that test. However, I believe, and I'm going to see if I can try to find the exact wording, I believe when they look at the amount that you could exclude as a charity, I believe it refers to funding from government sources specifically. And I do find it here, and I agree, or I'm confirming what I'm saying, Drew.
Okay.
There is an election that a charity can file to exclude certain funding from their revenue when they do the test as to whether they've reduced by 15 or 30%. However, it's the funding that they are able to exclude, it refers directly to government sources. So funding received from government sources. So for the individual who asked the question, that would be the question that they would need to determine is, does that revenue constitute funding from a government source? From what they described, it didn't sound like it, because it said, I believe the individual asked about funding from the United Way group.
And Region of Halton, which I think would be a
Region of
government source.
Okay, well, the Region from Halton part would be very interesting then, absolutely, Drew, that's right.
Yeah.
So yes, it says from government sources. So there's an election to exclude that. And again, it's important to note that that's an election, that's not automatic, but yes, for a registered charity, they may be able to exclude that government source from the Region of Halton, as you said.
Perfect. Another question from our viewers here. Can the the supplementary unemployment benefit plan, be done retroactively?
Okay, that's an interesting one. I'll say this. I mean, I should give a couple of caveats, and Sebastian and I probably should have put a caveat on this at the outset that, you know, you should still, this is a great discussion, but that is the purpose of what we're doing here. This is for discussion purposes only. And, you know, this should not constitute or substitute for your tax advice. You should consult with your tax advisor on this. In general, I don't believe that you can, because, and I could be wrong, but on the sub-P plan, it is a plan that in general gets registered with Service Canada. So it is a formal plan that you register. And I believe, and I'm not an expert on sub-P plans, as you can imagine, Drew, this is not the most common thing, but it certainly is becoming more common now. Mm-hmm. In order for the income to not be income for EI purposes, which is what the employee would want, it does need to be a formal registered plan with Service Canada. And there may be ability to be retroactive, I don't know, but I will say this again, that it is a formal plan that needs to be registered. And so as part of going through that registration process, you know, that's when you would do that deeper dive as to what your parameters are on paying that top-up amount.
Perfect. So back to another program, the Canada Emergency Commercial Rent Assistance Program. Under that program, what information do the landlord and tenant have to share with each other before determining if their tenant is eligible for that subsidy?
Right. Yeah, and as I mentioned in my presentation, I said that we're waiting for more information to come out on that subsidy. So that's been a bit of the, I don't know if I want to call it stumbling or hiccup in the way things have gone over the last, say, 6 weeks, is that announcements get made, and then there's a period where we wait to get some further detail. Further detail comes, and then there's a more of a wait until there's actually legislation or more formality behind the program. So this is one of those programs that is kind of caught right now in the fact that we've had an announcement. Again, I encourage people to go on the Canada CMHC. I think I got that acronym right. There's too many acronyms right now, Drew, in my head. Go on their website. They do have a good summary. Mm-hmm. But to answer that individual's question directly, we don't have guidance on what what landlords should be getting from their tenants to try to support that qualification. I would expect, or I'm anticipating that there will be some kind of maybe pre-populated form that a landlord could ask a tenant to sign. But no, nothing like that exists at this time. So that guidance is not out there at this time. I'm purely speculating. But there's no question, it's the landlord that's making the application, and it's the landlord that is saying, yes, the conditions are met and I'm eligible for the subsidy, but yet they're doing it on information that they clearly have collected from their tenants that, you know, they're not privy to. They're not privy to their tenants, you know, sales and things of that nature. So there's no question that the landlord should get something in writing from a tenant to substantiate that. But yeah, at this point in time, it's unclear. It's unclear what that would look like, but certainly that's a great question. And I think the person who's asked that question has certainly nailed a big issue as it relates to that program.
Yeah, no, certainly. We talk about this often, right, in this period, that these programs would normally take years to develop, and the government's rolling them out, you know, in a matter of days and weeks. And so we're seeing lots of editing on the fly, and it shows how important these engagements and consultations are, and flagging these holes so governments can react and whatnot.
Yeah, to that point, Drew, we're seeing changes get made. We're seeing the CRA come out, for example, where they're recognizing some deficiencies or some issues and trying to plug those holes through administrative positions, saying, okay, you know, we're going to allow on the CERB, for example, we're going to allow an individual to earn $1,000 in their claim period, as an example, right? Recognizing that we don't want to discourage someone in the gig economy, for example, from earning $500 or you know, up to $1,000. So that's a great example of where, on the fly, the legislation didn't really accommodate it, but CRA is bringing out an administrative position to allow for something. You're absolutely right about that, Drew. That these things are changing all the time, and they're adapting, and we need to stay current on them.
Yeah, Sebastian, I think you were going to jump in there.
Yeah, I was just going to say, if somebody is looking at the rental subsidy, the Ontario government has actually probably the best summary out of all three, CMHC, feds and Ontario, they've actually provided an example in there on how the thing works. So.
That's great. So building off that, there's a number of programs that the government's rolling out, which equal big dollars, and they're getting this money out to businesses quickly here. What checks do the government have to ensure the money distributed goes to the businesses that really need it? And building off that, you talked a little bit about the wage subsidy program and waiting to make sure you get it right because there will be penalties. What do those penalties look like, and what should people be looking for as we go through the application process?
Okay, all right, Drew. There were two or three questions in there. I'll try to respond to them. So, I mean, the first thing in terms of kind of checks and balances to ensure money is getting into the right hands. I mean, I think the government has acknowledged that some of the money is going to go to people perhaps that don't deserve it, and probably the vice versa, there's people that deserve it that have maybe fallen through the cracks in terms of eligibility. So, to your point about rolling things out quickly and trying to react quickly, which to their credit, in general they have. The programs are not perfect, and that's been acknowledged, and they're going to, or they've said that they're going to try to then backstop that through efforts in particular from the CRA after the fact, where the CRA will be following up on CERB applicants, for example, on the wage subsidy, the 75% wage subsidy, which would be the largest amount that's out there that's available to people. I think that they had budgeted $78 billion, I think it was, that they had budgeted for that program alone. They will have a check in place on your application immediately where it's going to look at your payroll account. So, for example, part of the data you have to enter is your gross pay, your number of employees. And so if your 75% calculation really doesn't match up to the number of employees you have, or to the gross pay that you're paying, and that doesn't match up to the actual payroll account in terms of what the CRA has received for payroll and remittances and such, then immediately it will trigger a flag, and there'll be a phone call follow-ups immediately before any money is released. And then after the fact, we are expecting that the CRA is going to have a lot of audit activity around it, again, to the point about how much money has been released. So we would expect there'd be a lot of audit activity around it. In terms of penalties, there is a 25% penalty for overclaimed amounts. There are penalties in place where there's negligence in the fact of the way you maybe have manipulated your revenues to meet the drop in revenue test, where you have manipulated the amount of salaries paid during the eligible period. So, for example, you took July salaries and moved them forward into the claim period, for example. If you've done things of that nature, there would be penalties for that. There's additional penalties in the Income Tax Act for false information claims, so your penalty could actually get up to, say, 225% of the claim. And sorry, I should say that's just the penalty amount. You would obviously need to repay the amount of the overclaim subsidy as well, of course. In addition, the one individual on behalf of the organization will have to attest to the accuracy of the claim, and that individual could be subject to criminal prosecution, again, if there's a false claim. So I hope that helps to answer that question. That was a lot in that question, Drew, but I hope that helped.
Oh, I think you did a good job there. When you pay, we're talking about the interest-free loan, and with the $10,000, 25% forgivable if you pay it back on time. But when you pay $20,000 to subcontractors, does the business qualify for the tax-free loan?
The qualifications for that loan, for the $40,000 loan, are very clear that it's tied to the business's 2019 T4 summary. So T4 is for the calendar year 2019. So that individual should look at the T4s that have been filed, and of course all your T4s as an employer are aggregated onto a T4 summary. Look at that T4 summary to see if it's between $20,000 and $1.5 million of total salaries paid for the calendar year 2019. So if it's subcontractors and you have not issued a T4 to that subcontractor because it's not an employer-employee relationship, then that would not qualify, because it's specifically tied to employment income paid by the business, again, between $20,000 and $1.5 million for the 2019 calendar year.
Okay, great. So this question is around shareholder withdrawals in 2019. So the individual is wondering if they qualify for the CERB if they made shareholder withdrawals in 2019, and if they don't qualify for the CERB, what do they qualify for?
So yeah, I'm not sure the shareholder loans. We probably have to get more details from the individual to understand exactly what they're asking, but certainly one of the qualifications for the CERB is that they've earned $5,000 of income from different sources, employment, self-employment, and certain maternity, paternity type government benefits. And they must have earned that $5,000 within the previous 12 months prior to their application date or in the calendar year 2019. So if they have done shareholder draws and though that's not income to them, then if they didn't otherwise have income, then yeah, they would not qualify. So shareholder draws in themselves would not qualify because they do have to have income. For what it's worth, I will add that this is another example of where the CRA has come out with an administrative position to try to help people qualify. So what they've done is they've said if you're receiving dividend income, so maybe you didn't have employment or self-employment or those maternity, paternity, EI benefits that I mentioned, but instead you had dividend income from your company and it's a private company. So it's what's called a non-eligible dividend from a small private company. That dividend income can qualify for that $5,000 income test that needs to be met. So that might help the individual if they otherwise had dividend income. But purely just shareholder draws, I mean, that isn't income to the individual and therefore would not meet that qualification. I think that's what the individual might be getting at.
Okay. Yeah, hopefully that answers it. But if not, we'll send you some follow-up questions there just to get some clarification. The last question I have in the queue here is back to the wage subsidy. The 75% wage subsidy requires a decline in gross revenue. How does this work, both from the perspective of the comparison to prior periods, as well as determining what revenue is?
Okay, yeah, no, that question has generated a lot of interest. And there's no clear-cut answer. I'll make a few comments. So as it relates to the prior reference period, there's opportunity. And again, the point of this, what I believe, was for the government, again, trying to have more entities be eligible for the subsidies. So you can look at your gross revenue for the month of March and you compare it back to March of 2019, or you can compare it back to an average of January, February. But you can't change between the periods. Once you've chosen the method, you're going to compare back to 2019, or you're going to compare back to that average of January and February of 2020. You need to be consistent in that methodology throughout all three periods. So when you look at test your March revenue, test your April revenue, and test your May revenue, you need to have the same prior reference period, either those same months of 2019 or an average of January, February of 2020. In terms of what revenue qualifies, the legislation is intentionally, I would suggest intentionally, not being specific in that regard, because if the legislation is too specific, it makes it very narrow and makes it difficult to navigate. But so intentionally, it's broadly worded as your normal, pursuant to your normal accounting principles, how you normally would account for revenue. And basically it just says a very general way, your gross receipts during the period. I will say that there is an election to help you, again, to try to help more businesses qualify. You can elect on what's called the cash method. So if your normal method of accounting is accrual accounting, which that would be the case for most people or most businesses, you do have the ability to elect under the cash basis, which basically means cash in the door during that month. So you can elect under the cash method if that would help you qualify otherwise. So you do get that assistance as well. But when you get into some of the nitty gritty, like I have investment income, for example, it's away from my ordinary course of my business. Does that qualify? There are some specific carve-outs. So they do carve out extraordinary items. So for example, if there was a one-time event of some kind, like you sold part of your business, you would exclude that. Capital items are excluded. So again, if you have a piece of machinery and you've sold that piece of machinery and you've had a gain on that sale, that would be excluded. So there are some specific things to exclude and to help you. But in general, you would need to get into it a little bit in terms of what is your ordinary activities, what are your ordinary receipts. But it is possible, for example, investment income could be excluded for that purpose.
So we have one final follow-up that just came. Oh, I know, went away, I believe. So
They withdrew.
They withdrew. On that note, Sebastian and Aaron, thank you both so much for joining us. I think it was a really informative hour. We've made a recording of this session, so we will share that with everyone that attended today. If you do have any follow-up questions, please pass them along to Becky or myself at the chamber, and we'll make sure the folks at KPMG get those, and we'll hopefully provide that information. So once again, thank you everyone for tuning in, and thank you, Sebastian and Aaron, for taking the time to participate.
Yeah, thank you, Drew. Thank you, Becky.
Thank you.
Take care, everyone.
Bye-bye.